Well, in keeping with the recent interest we have seen in the auto ancillary stocks, MM Forgings, that's the stock under the microscope. Remember, the stock has seen a bit of a run in the last few months, but in comparison to the peak that we saw of 2018, well, it's still close to around 40% away. And even if you're looking at the peak of 2020, it's close to around 10% away. Now, the reason the stock features under Midcap Microscope is that it's a CV play. It has potential to double its revenues in comparison to what we saw in FY20 without much capex, and also they've been gradually deleveraging the balance sheet. The company is a manufacturer of closed die-hot forgings, and it also has auto customers in both the domestic as well as the export market. It's a play on the CV cycle revival, as it gets close to around 75% of its revenues from the CV space, and also the company's geographic mix, well, it's split down the middle. 50% comes in from the export market, 50% comes in from the domestic market. Now, in terms of the financial performance in this fiscal so far, it's been a washout. Decline in revenues, margin compression, and they reported a net loss. But there were a few positives as well. The finance costs declined by close to around 20%, implying there was some debt repayment. Additionally, its cash conversion cycle has reduced from around 36 days to around 22 days in the first half of this fiscal. That's primarily due to the increase in the payable days. Now, the company sits on a cash balance of close to around 180 crore rupees. Now, in the past few years, the company has been doing production of roughly around 45,000 to around 65,000 odd, but they have a capacity of more than 110,000 odd. FY19, by the way, was their best year. They did revenues of around 930 crores, margins of around 19%, and also EPS of around 27 rupees per share. The big question is, can they better this performance in FY22 or FY23 and do an EPS of around 35 to around 40 rupees? Then you give it a possible multiple of around 15 to around 18 times. That'll be still lower than what its larger peer like Bharat Forge gets. Remember, since they have surplus capacity, and if the CV cycle turns for the best, well, the company can clock revenues of around 1,500 to around 1,600 crore rupees without incurring big capex. Now, some of the other factors that you should be tracking, well, they're looking to focus on larger forgings. Now, that comes in with better margins. And if they can reduce the debt from here without much capex on board, their balance sheet will look much better. Before we wrap up though, a quick look at the shareholding pattern. Promoters at around 56%, and you have 15% that's held by large funds as well as a large HNI. Keep an eye out on this CV play, MM Forgings.